My brilliant take on a 1035 insurance exchange, or any exchange for that matter. In this episode, I'm going to explain what a 1035 exchange is in relation to a permanent life insurance, and what are the benefits, the advantages of doing a 1035 exchange. And I'm going to end up showing you a strategy that's actually brilliant that most insurance agents do not understand or have a clue. So get ready. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for north of 5 decades, helping thousands of Americans optimize their assets and minimize taxes and empower their authentic wealth. One of my favorite financial vehicles, without question, if you've watched very many episodes on this channel, is a properly structured, maximum funded indexed universal life, what we call IUL. Now, oftentimes when we meet clients, they will come to us to optimize underperforming and non-performing assets. This means that they have money invested in various places that do not pass the liquidity test, the ability to access their money when they need it. The safety test, they can lose their principal in there. You want safety of principal. The rate of return test, in other words, you've got to have a rate of return greater than the inflation rate at the time, okay? You need a rate of return more like 7 to 10% or higher. And it's not totally tax-free, okay? Now, life insurance, you can accumulate money tax-free if you adhere to the Internal Revenue Code. You can access that money income tax-free, and when you die, it blossoms and transfers income tax-free to your beneficiaries, your heirs, okay? Now, those are the benefits of properly structured insurance. Now, when we talk to people about max funding insurance, you're taking the least amount of insurance you can get away with in the Internal Revenue Code, okay? And you're putting in the most money the IRS allows as fast as they allow. And so you're determining the amount of money that you want to reposition into that. Oftentimes, people reposition money that's sitting around in banks and credit unions, earning a pathetic return of only 3 or 4%, and they want to have a higher rate of return that's tax-free instead of 3% taxable. That's a no-brainer. Sometimes people are sick and tired of having their money in a volatile stock market portfolio, and so they want to get rid of that market volatility. And so they come to us and say, hey, I took my money out of the market. I want to put it into index universal life where I can participate when the market goes up, but not lose when the market goes down, which is what IUL does for you. Some people do strategic rollouts out of their IRAs or 401ks to get the taxes over and done with sooner than later, and then reposition that into a tax-free vehicle. So they'll have tax-free retirement income. And when they ultimately die, it reimburses them for the tax they did pay during the rollout, okay? I'm not talking about a rollover. That's a rollout. So a lot of times people are repositioning assets to increase liquidity, safety, rate of return, and tax benefits. Well, that's also true with any life insurance they may have. Sometimes the insurance coming along for the ride under the IRS guidelines is enough to equal or exceed maybe term insurance that a client has. And if they feel like they don't need both of those policies, they sometimes let the term insurance go because now they're being insured from a maximum funding and IUL policy. And it's actually using otherwise payable tax to receive that insurance. And if you don't understand what I just said, you ought to watch several episodes about how max-funded IUL works and how basically a minuscule portion of money that would otherwise go out the window in unnecessary income tax actually pays for all the insurance when it's structured correctly, okay? We don't object to insurance benefits, we object to paying for them. That's why I let, Uncle Sam pay for my life insurance. And even though there's millions of insurance coverage on me, I don't even look at it like I'm paying for it. It's being paid for with a minuscule portion of money that most Americans shell out in unnecessary tax on their tax-deferred IRAs and 401ks when they ultimately retire. Coming back to insurance, sometimes people have permanent life insurance. That's called cash value insurance. It could be whole life insurance. It could be universal life. It could be variable life. And it was not structured correctly. And so we do an audit on the policy. And oftentimes we show them, this policy is going to crash and burn. You've had this whole life policy for 20 years, or look at this policy. In 20 years, the cash value doesn't even begin to equal the amount of premiums you paid into this. Who structured this? Did you do this primarily for cash accumulation or just for death benefit? And when they say, well, for cash accumulation primarily, well, they didn't structure it correctly. Your cash value should equal and exceed the premiums you've paid in by the fifth year if it was structured correctly, and you're maximum funding it for like a 55 or 60-year-old. And in 5 years, you're putting in all the premium the IRS allows. I mean, heavens, your cash value needs to equal and exceed the death benefit, usually by the 10th to 15th year of the policy. Well, we come across many life insurance policies that don't even come close to that. People will pay into these policies for 30, 35 years, and the cash value doesn't even begin to equal the amount of premiums they paid into it, okay? So once they learn about properly structured max-funded IUL, they would like to exchange it. So once they get approved, the IRS has a section in the Internal Revenue Code, Section 1035, which is very similar to Section 1031, which is about real estate. Section 1031 is where people who have a highly appreciated real estate, they can sell that rental property, let's say, and then they can buy another rental property of equal or greater value, a like property, and they can do a 1031 exchange. And so they don't have to take any of the money from the previous property when they sell it and put it in. A lot of people don't know that. They have to buy a property of equal or greater value. They can finance the new one 100% loan to value like I do. You don't have to take any equity out of the previous property on a 1031 exchange. But they do that in order to defer paying capital gain tax. Well, in an insurance policy, a 1035 exchange allows you to transfer the basis and the cash value of the old policy over into a new policy and continue to get the tax deferred benefits, and also to grandfather you for the amount of money that you paid in the basis into the policy. So if that went over your head, let me explain it this way. The advantages to doing a 1035 exchange would be that if you have some cash value in the old policy, if the cash value does equal more than the premiums you paid in, but it's not still structured very well, you may want to transfer that cash value over into a new insurance policy, because if you just cancel the old insurance policy, you will trigger a taxable event on all money, all cash value you have in that policy over and above the aggregate premiums you paid into it, okay? Now, more often than not, we have people that come to us and they've borrowed on their whole life policy or their universal life policy, and they owe $100,000 or $200,000, and it's just being charged at an interest rate. This is very common with whole life. The insurance company is charging an interest rate, maybe like 6%, and they're only crediting you 4%. So you're earning 2% less than what they're charging you for the interest on the loan, which I've never understood why people think that's a good idea with the banking concept with whole life. Indexed universal life, if I borrow at 5, I usually earn an average of double that, 10. I get credited more than what they're charging me for the interest. But we see a lot of whole life policies where it's the opposite. And if you just sit there and try to pay the loan interest the rest of your life, you're going to drown, okay? And so we had a client that came to us with that situation, had a $200,000 loan, and they couldn't even keep up with the interest payments on it. And because of this negative interest rate that they were being charged against the policy compared to what they were being credited. So we did a 1035 exchange. Now, in this case, that client did not have to pay off the $200,000 loan because we found a company that would accept the new loan. Now, the new company with a property structured IUL was crediting way more than what they were charging on the loan. It's the opposite of what the whole life company was doing. And so that $200,000 loan ended up being paid off within a few years. And not only that, but then it started to build up the cash value versus if they would have hung on to the old whole life policy, it would have crashed and burned. And they would have been constantly paying more and more in interest payments on that loan. And so you can rescue policies that were not structured correctly or that are sort of underwater by doing a 1035 exchange. Now, here is something that I think is brilliant that most insurance agents don't understand. So I'm going to try to simplify this. Let's say that I have a client that has a permanent life insurance policy, whole life or universal life, maybe even variable life, and they have $200,000 of cash value in their policy. Now, I analyze this because we audit policies to see if they're underperforming or non-performing. If they're performing well, we say keep it. If not, after the audit, we show you how much better off you could be. So if this client had $200,000 of cash value, we analyze how much could they have put in that policy up till that point. Now, let's say they could have put in $500,000, which is called the guideline single premium. They could have put that much into the policy during the first, 4 years and 1 day. For most people, that's the maximum they could have put in. They didn't, obviously, because they only have $200,000 in there. This is what you can do. You could take and do a 1035 exchange of the $200,000 and put it into a new property structure max-funded IUL. But now the client who maybe has $300,000 or more dollars they want to put into the new policy, they can't put that in all at once because they would violate TAMRA, the Technical and Miscellaneous Revenue Act of 1988. They would create a MEC. And so sometimes people just say, well, we're going to have to wait to put in your $300,000 over the next 2 or 3 years. No, you don't. We have many times said, well, you have $500,000 of room in your old policy. You're going to get rid of it. But before you do, you could pay $300,000 into your old policy, and we'll do an analysis to see if the policy charge for doing that is worth it. But you put in $300,000. Now the old policy is max funded. Then you do the 1035 exchange over to the new IUL policy, and you get all $500,000 into the IUL policy in one fell swoop. You've complied with TAMRA. You haven't created a MEC, and that thing is off and running with interest being credited on the full $500,000, which oftentimes offsets any policy fees that were incurred by you max funding the old policy. And maybe the agent, they'll be tickled that they got compensated for that last $300,000, but you need to have it analyzed. That's the point of this episode. When I have shared this with people, they have said, Doug, that is absolutely brilliant. We were able to comply with TAMRA and do a 1035 exchange and get all of their money in one single premium, and it's all growing tax-free from this point forward. Well, if you're wondering about how you can take advantage of an IUL policy, I would strongly recommend you study my most recent best-selling book, The Laser Fund. A laser fund is a property-structured max-funded IUL. It stands for liquid assets, safely earning returns. That's the acronym LASER. Now, this book has been flying off of our warehouse shelves. It is actually 2 books in one. This side is the left brain side. If you like charts and graphs and explanations, there's about 200 pages there comprising 14 chapters. But if you're more of a right brain learner, you learn more by stories, you flip it over to this book. This is about 100 pages, 12 chapters with 62 actual client stories. This retails on Amazon for $20 up to $60, but I'll gift you a copy for free. You simply go to laserfund.com, click on the link below, contribute a nominal amount towards the shipping and handling. I require a little skin in the game, but I'll pay for the book. I'll fire out a hard copy to you via priority mail. And when you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's those formats available for your investment. You can schedule to attend an educational webinar. We teach every week, absolutely free, no cost, no obligation. You can even schedule an appointment to talk to an IUL specialist that will show you how a properly structured max-funded IUL will perform in your particular set of circumstances. So this is not about us or me. This is about you and your brighter future. Claim your copy of the Laser Fund now.